Hi, everybody, and thank you very much for joining this evening. I will just jump straight into this because I've got quite a lot to cover. So we at CentralNic just announced our half-yearly results last week, and so I'll just take you through the deck, which includes those numbers as well as a description of our business. So firstly, our key highlights is that one of our two business segments, our online marketing segment, actually achieved 98% organic growth in the first half of this year. Phenomenal performance for that business segment. But looking at the accounts overall, we can see that the operating leverage has really come through like it never has in the past. So if we go back only a year, our EBITDA was 36% of our net revenue. In the first half of this year, it was 47% of net revenue. So clearly demonstrating that we operate a platform-style businesses with relatively fixed costs, and when we can drive up the number of transactions over those platforms and the value of them, then we get much better EBITDA percentages than we did before. So our organic growth has been widely recognised. The FT listed us among the 50 fastest growing tech companies because that's what we do in Europe. And we've now been included in the FTSE Russell AIM 100 and the AIM 50 indices for the first time. But it's not only an organic growth story. We also made a significant acquisition this year of a German comparison website company. It'd be the German equivalent of a Future or Which in the UK. And that company cost us $65 million US, and we acquired it through mostly a placement of shares here in the UK with our existing investor base, and the timing turned out to be very unfortunate that we raised the money in the first week of the invasion of the Ukraine. However, and this is testimony to the support of our shareholders, we were actually oversubscribed and raised over 42 million sterling to make that acquisition. Now, we'll move on to our business profile, what we do. So CentralNic IPO-ed back in 2013. And up until the end of 2019, we only had this business, which we still have and still love and nurture. And we call it our online presence business. And the main product being sold on our online presence business is domain names, the names that are used for website and web addresses and for the basis of emails for companies. So the way we built that business was we made multiple acquisitions of companies with different suppliers and different customers within the domain name business. And then we merged them together. And that merging together allows us to essentially have access to almost every supplier in the world, and to have 3 channels for our customers. So the first thing is a real engineering feat, because there's about 1,500 different domain suppliers in the world, and as there are domain names for every country, so just as we use .co.uk in the UK and .com.au in Australia, every single country on earth has their own domain name, and in fact there's another 50 territories. So it's not just France, but it's also French Micronesia, French Polynesia, French Guiana, and so on. Each have their own domain extensions, we call them. And most of those are run in the countries themselves. So that means we've had to contract with companies in almost every country in the world, do the engineering work to connect them to our platform, organize how to make payments, how to update the policies, and so on. All over the world. And so that's at the bottom there of this chart. And in addition to domain names, there are bundled services like Microsoft Office 365, like security certificates, which we've also started to sell. And we expect to see that as being a big growth driver in future. So even though we've got all the domain names, there are new products that we will be launching and rolling out over years to come. Then when we look at the top, our customers, there's really three types of customers, three channels to market for us. Firstly, resellers. So we supply these domain names to many of the biggest domain name retailers in the world. GoDaddy is the best known one, certainly the largest in the United Kingdom. Google Domains is the fastest growing one in the world. WordPress is, of course, the most popular software for building websites in the world. And then we have 20,000 additional resellers all over the world again. We have our retail companies as well, where we're selling direct to entrepreneurs, building websites, building their businesses online in almost every country in the world. And then lastly, we have an enterprise channel, because enterprise customers like Mercedes-Benz and Johnson & Johnson and Rolex look at domain names as in a particular way as the trademarks of the internet. So just as they go to their IP lawyers and ask them to register their trademarks in every single country in the world to protect them, they also come to us and ask us to register domain names relating to their brands in every single country in the world, again, to protect them. Now, this is a fabulous business that we're so happy that we've been successful in building. It has some great characteristics for investors like us. Namely, one, all of these products are subscription products. So in other words, the customers have to pay us every single year to retain the use of these products and services. And if they don't pay us, their website goes down, their email stops working, their cyber squatters grab their branded domains and so on. So bad things happen. And what that means is it's an extremely predictable business that just works like clockwork. Another amazing advantage of this business is in this industry, only 2% of customers switch suppliers each year. And that's because of high costs, high risks, and high complexity of switching. And then lastly, of course, as mentioned, there's plenty of upside for us in this business with additional products and services to bundle. And also we are continuing our mergers and acquisitions plan, especially as values of tech companies are low at the moment. Fantastic opportunities out there to continue to build our business through acquisition. Now, let's move on, because this is one of our two segments. Our other segment we call online marketing. And our online marketing business, we built in exactly the same way as online presence. We made multiple acquisitions of companies with different customers and companies with different suppliers, and then we merged them together. And in this case, we hit the jackpot in the way that this business is working. So we acquired a business, and I should add to this, because we've only recently got into this business, we acquired these businesses knowing full well about changes happening in the internet, like the banning of third-party cookies, Apple's restrictions on companies collecting private data and so on. We really bought these businesses to be future-proofed. So our businesses are completely privacy safe, make no use of cookies, don't collect private data or sell it or anything like that. And so we feel like this is just the most robust and future-proof and sustainable business out there. So who are our customers, I guess? Who gives us the money? And so through making multiple acquisitions, we now have a business that has been a publishing partner of Google's for 12 years. And by Google here, we're talking about Google Ads. So this is the revenue driving part of Google. Google Ads is by far the most popular platform for businesses to place ads on the internet. It has the tools where you create your ads, where you program in the return on investment you're looking for, so how much you're willing to spend on a customer to acquire a customer in order to ensure you still make a profit from them. And whilst Google owns the two most popular websites in the world, google.com and youtube.com, these only absorb 75% of the amount of money they're collecting from advertisers. They can't place enough ads to absorb all that money. So they're spending over $50 billion on their partners. And so these partners are publishers like us that have websites that we can place the Google ads on. And when people click on the Google ads, Google bills the advertiser, collects the money, keeps some of it for itself, and passes on the balance to us. So that's our Google Ads relationship. Amazon also is a massive advertiser. Again, over $40 billion this year being spent on advertising on the internet. And where do they get the money from? It's called co-op advertising. So they go back to their suppliers that provide them with the vacuum cleaners and the toasters and the microwave ovens and the books and so on, and essentially get marketing dollars from them, which and it makes a lot of sense. They get a lot because obviously as Amazon becomes a more and more important retailer, people tend to give them the money, because if they can improve with their marketing spend sales by 10%, that's probably the most effective marketing dollars that their suppliers can spend. So then through a second acquisition, we have now a company with a 7-year-long relationship with Amazon. And then lastly, through a third acquisition, we've got our own ad agency platform. So big brands use advertising agencies, and they this year are spending $70 billion buying traffic direct from publishers like us, or in other words, placing ads directly with publishers like us. And now we own our own platform where these advertisers can actually sign up and use our tools directly. So as I mentioned, we're a publisher. Where does our traffic come from? Two places. One, by traffic, I just mean people surfing the internet. So how do they make their way to our publications, our publishing websites? Two ways. One, small minority, through click on links, through finding us in search results, through just typing in the name of our websites. The vast majority, we do what's called redirection. So in other words, we hire media buyers to place ads on Facebook, on TikTok, on Google, on Bing, and so on and when the people click on those ads, they come to our publications. So enormous market, as we're going to see. Again, it's a recurring revenue business, but this is more of a utility style, which means that we have a relationship with a company, and instead of getting paid once a month or once a year, like we do in the other business, we get paid every single time they win a new customer, which often they want to happen as often as possible. So we get paid continuously on a rolling basis for use of our services. So I'm going to show you now the size of the different markets. So the domain market, $7 billion a year, a reasonable size. The online presence, value-added services market. So this is the market for things like website building software, email software, things bundled with domain names. A further $53 billion that we can access, and that's really going to be the driver for that segment of our business. But online marketing, a hugely bigger business, $60 billion will be spent this year on online marketing, and the underlying growth of that, 22%. So in other words, 22% of $600 billion will be additional spend made next year, which nobody has claimed to yet, and everybody can vie for, including us. So the end result of addressing these two markets and our two businesses, our two marketplaces is this. Online presence, around $150 million invoiced in the last 12 months, 5% organic growth, extremely respectable in that segment. But the superstar in our business is clearly online marketing. Almost 100% growth year on year, up to $460 million in revenues. You can see the orange there is where we've adjusted. The way we calculate organic growth is we look at all the companies we owned at the end of June of this year, and then we look at the same companies for the prior year, even if we didn't own them back then, because we want a true like-for-like comparison, and that's what we've achieved here. So how do we get our business to grow so fast? And this is how. We showed you our demand-side partners. Google spending $56 billion this year on placing ads on third-party publisher websites like us, and that's their revenue share. That's the publisher's revenue share. Amazon, an additional 44 billion, making them the biggest advertiser in the world. And of course, the ad agencies, another 70 billion. But that's not it. There are other companies that we could sign up as demand side partners. And indeed, Yahoo, we've now already signed a contract with. Microsoft is in our targets, as is Apple, and there are others as well. So even though we're doing amazingly well, doubling our size year on year, we still are only at 0.4% market share for the Google and Amazon spend, and only 0.05% of the ad agency spend. In other words, we are a tiny drop in the ocean for these companies. We're addressing an enormous, a tsunami type opportunity here in terms of the amount of cash that these companies have to spend on services like the ones that we render. Now, I mentioned we're a publishing company. We're a publishing company unlike any other. We ripped up the old publishing model and developed an entirely new one. The old one, the traditional one, is this. Think about the Times, for instance, or FT. Think about the FT. Small number of websites, each website focused on very specific areas, sports, maybe not so much for FT, like news, finance, markets, how to spend it, etc. And these sites are very expensive because they're created manually by content creators like journalists, photographers, graphic designers, editors, and so on. And the traffic tends to be large numbers of people of the same type of people, even the same people, returning again and again. So we do something totally different from that. First of all, our website, we have an unlimited number of websites because we build our websites in a fully automated manner using artificial intelligence and optimized after exactly 12 years of being in this business. So we currently have 25 million websites on the internet. Now, these websites don't have articles on them. We don't use journalists. We don't use photographers and so on. We have some content on a few, but the vast majority of them only have advertising on them. That's it. They just have ads on them. And so what do? Each of these 25 million websites represents a tiny micro category of an advertising category. So if we thought, for instance, of dentists as an advertising category, we would have a page for dentists in South Kensington, another one for dentists in Fulham, another one for dentists in Chelsea, and so on and so forth. Not just suburbs of London, suburbs of every city in England, every city in Europe, every city in North America as well. So literally tens of thousands of websites only dedicated to dentists. And then we have a whole bunch of other categories as well. Now, these sites are created by computers. They're fully optimized because we've been doing this for years. So that means in terms of the color, the layout, the font, and so on, they're fully designed just to get people to click on the ads as much as possible. And again, why do people come to the websites? It's not because of the content. It's because we actually buy the traffic and get the people to come to these websites. And just before I go to the next page and explain that, which is the kind of third part of what makes our business so scalable and so sustainable, is that Google reckons there's about 5,000 different categories of advertising. We're addressing less than 10% of those categories at the moment. For each of those, we're building thousands of micro pages, pages for micro markets, but there are still thousands of categories of advertising that are still untouched by us. Now, last component of our super scalable marketing, and it works like this. We hire media buyers to place ads on, say, Facebook. And so continue with the dentist analogy. So that ad might say, great value for money, family dentists in your area. They click on that ad. So someone using Facebook clicks on that ad. Facebook tells us, hey, that person's in South Kensington. So they go to the South Kensington dentist page. When they get there, all there are is ads for different dentists in South Kensington. They click on one. and then go make an appointment with the dentist. The moment they click it, Google takes the money from the dentist, their customer, holds onto its share, and then pays us our revenue share. And then this is the clever piece of what makes it so scalable. Then we pay a revenue share to the media buying company. So we've rewritten the rules for media buying. Historically, the way a media buyer would work is a dentist would come to them, say, hey, build a new website for people to make appointments online. I'll give you £10,000 for the year. I want you to put ads on Facebook. And then when people click on the ads, they come to my dentist's website and they make appointments. What we've done is we go to that media buyer and say, look, we've noticed that you're great at buying ads for dentists and you've got a few great dentist customers, but you should sign up with us as a partner because we have an unlimited budget. Our partners are spending $100 billion this year, and we will give you as much money as you can earn. You just get us dental customers all day long, and we don't care where they are. Anywhere in the world is fine. But the twist is it's on a revenue share basis. So in other words, we only pay you if we get paid. And that has made us the best customer that many media buyers have ever had. It means that they've grown from dealing with their small budgets to literally billing $1 million plus to us every single month. Hiring staff, writing new software, and so on. And so we've created an ecosystem of media buyers that has driven an enormous amount of growth, as you've seen in our business. So that's how we do it. What does it look like? Let's get into the financial results. In summary, H1 this year, $334 million built, almost doubling the results last year. Net revenue, 82 million, 50% up. Adjusted EBITDA, over 38 million, again, almost doubling. Earnings per share up 60%. Operating profit, we were roughly break even. We're north of $20 million now in operating profit, and adjusted cash flow, $42 million, up 64%. So this is one of the key things about our business. Not only do we grow fast, not only are we profitable, but we convert more than our EBITDA into cash. So let's quickly just have a look at the income statement here. I've mentioned what the key things are here. Significant uplift in operating profit there. I'm sure it's something that we all love to see, that just on the numbers here, 600% increase in that number. Now, it does look like the gross margins are coming down as a percentage. Indeed, they are. You can see there from 31% to 25%. But to be clear, within each line of business, margins are solid, are rock solid. The change here is that this media buying business is a lower margin business than many of our others, because clearly we've got this media buying partner in there, which brings down the gross margin level. So we're not seeing a deterioration of margins in any of our businesses. What we're seeing is enormous growth from our lowest margin business, and hence that's changing the blend. We are also super serious about ESG, diversity, inclusion. We're actually a carbon neutral company, and we're a company that has a significant grant program for technology in the community. So technical innovations to help the disabled, to bring cybersecurity to schools, those kinds of programs as well. But with that, let's go to questions.
And thank you very much. Lots of really positive comments, a lot of very positive questions. Again, I can bring some of those together into a bit of a theme. Everything looks fantastic, but it seems to be selling after positive news. Comment, if you're able to, what would it take for a kind of consistent rise in the share price, do you think? To reflect the positive results and the positive news that the company is generating?
Well, I'd say, yeah, we're kind of counter-cyclical, that every other tech company is is struggling. Not everyone, but a lot of them are struggling, including the best known names at maintaining their growth. And so I think what's happened is most of our institutional investors are investors in tech, and they are having a horrible time. I was talking to one earlier today who said that their portfolio is at an all-time low valuation. And I guess what that means is some of those funds then need to get some liquidity, and unfortunately, we tend to get sold down just because our share price has actually held up better than many others. So it has created some downward pressure on the share price. But look, I mean, my view is simple: keep our heads down, keep growing this fast, produce phenomenal results, and we'll get re-rated. And obviously, anybody that gets on board now will be enjoying the benefits of that. I think it's tough for anyone to get re-rated in such a down market that we're in right now, with so much kind of fear. But yeah, obviously, yeah, as Warren Buffett says, yeah, now's the time to buy.
Thank you. A lot of questions also about takeovers, being a takeover target perhaps, and also the acquisitions that you make. So on the former, being a potential takeover target, we've seen lots of UK tech firms being acquired, or conversations, with UK tech companies. I'm sure you can't comment on anything directly, but do you see that as potentially something for the business? Would you?
Look, what we have, or I have a philosophy of having open channels of communication with potential buyers of the business. I think it helps us make strategic decisions. So we understand what the appetites of potential trade buyers or PE funds would be, and it helps us make sure that when we make strategic decisions that they're in line with what future owners might want, or if they're not in line, we know what we're doing at least. And I'd say that, there's terrific interest in businesses like ours, but bear in mind, the business has changed very much. Remember, it's only in 2019 we got into this online marketing sector. It's only in H1 of this year that we got 100% organic growth. So we're moving very quickly, and I guess if people could keep up with us, then we'd get into some kind of serious discussion. But clearly, at this stage, we haven't. But I'd also say the sector we work in, there are multiple roll-ups in this sector, including us. And I guess maybe that gets onto your next question about us doing acquisition.
The other side, when you are the acquirer, the question was talking about how do you keep the people, how do you retain the talent in the companies you acquire, and how do you retain the culture?
Great questions. So yes, we have actually never done a significant layoff. We have a very specific acquisition philosophy, and that is we're value buyers. We don't overpay for acquisitions, and so we're not in the situation where we've overpaid and then we have to lay off a lot of staff in order to justify post hoc the amount we paid. Our philosophy is more find the companies where we can buy them at good value and then invest in them to get them to grow faster. And that obviously has worked out very well for us. And so, of course, sometimes some staff leave and so on. I mean, clearly, if you buy a company in a regional town where everybody was very interested in having a kind of lifestyle type of job, and then you bring them into a global environment where you expect them to do calls early in the morning and late at night with colleagues in other countries and so on. Sometimes they just don't like that. Other people absolutely thrive on it. They find it very exciting to be part of something bigger. So, in fact, we often have to change the culture a little bit, and that does mean that sometimes people leave, but it also attracts people that probably would never have joined those companies before. So we have a real mixture. We have a big focus on culture, and and clearly, because we do have staff from many different companies, one of our key cultural values is collaboration, because that's it, and also things like transparency, taking responsibility, those kinds of things. And we find that those people that are on board thrive and enjoy and get ahead, and they're obviously, you know, the people that are going to build the company moving forward.
That's terrific, Ben. Thank you very much indeed. I think the last time I saw you, Ben, it was just the domains business a few years back. So it's, you know, it's really, you know, like terrific the amount of progress you made in you know, really just a very short period of time. And so thank you very much for the update. Really appreciate that.
No, look, appreciate everybody's time today. Thanks so much for listening. And yeah, look, if you have more questions, you can always feel free to just write to us direct at CentralNic. We're very responsive, and you know, always love to hear from investors. Thanks very much.